Good afternoon, everyone. Thank you for joining us today from so many countries, including the UK, the US, Switzerland, Germany, Spain. So welcome to all to our World Stars Global Equity webinar. Thank you for your continued confidence and trust in our firm. Thank you as well for your patience during this period of market volatility. We value all these very much and take them seriously. I'm joined today by our CIO, Chris Rosbach. Our goal today is to update you on our World Stars Global Equity strategy, to discuss our performance and our conviction about our investment approach and about our portfolio. We look forward to hearing any questions you may have and a discussion after Chris's update. Please continue to send those in the chat or per email. As always, we begin with a reminder of who we are and our investment philosophy. We are an independent asset manager with $2.5 billion of assets under management on behalf of institutions, endowments, wealth managers, trustees, and families. 20% of which is on behalf of my family, the partners, and employees of the firm. We believe this provides our clients with a powerful alignment of interest. We manage 4 investment strategies on behalf of long-term investors based on fundamental research with a core focus on quality. Our sole mission as a firm is to deliver strong long-term returns on behalf of all our investors in a disciplined, repeatable, and rigorous manner. For the World Stars Global Equity strategy, with about $2 billion under management, we have been and remain committed to our investment approach of running a concentrated, high active share, low turnover, quality global stock strategy. And this has produced a net return of 12% per annum over the last 10 years in US dollars. With that said, in the last couple of years, whilst returns have been good in absolute terms, they have not been as good as we would expect them to be relative to the market. And this year, so far, our absolute return is just positive. We're always looking to understand our performance and to be consistently improving. So we've looked at these results, and our analysis shows that most of the underperformance of the last 2 years is explained by our investment philosophy being out of favor for an extended period of time. As many of you will know, quality is for us the gating condition for us to invest in a company. Since the middle of 2024, these types of companies have underperformed the market by about 11%. In addition, areas we typically not invest in, such as utilities, energy, and balance sheet-driven financials, have rallied during that same period. Chris will go into the details of performance and explain the headwinds and tailwinds we have experienced, talk about what we have learned in this kind of analysis period, and tell you why we have a high degree of conviction in our portfolio and why especially we're excited about the months and years ahead. Chris, over to you.
Thank you, Jerome, and welcome everybody. We're navigating a period of significant geopolitical uncertainty. It's having a real impact on the confidence of corporates and consumers, and of course on the companies we invest in. Today, I want to give you a thorough update on the World Stars Global Equity strategy, our performance, what's driven it, some of the specific holdings, which I think deserve attention, and why we have high conviction in where the portfolio is positioned. So as Jerome said, please send us your questions in the chat. We'll take as many as we can after the update. So let's look at the net performance of the last 10 years versus the MSCI World. Our goal is straightforward: to generate strong absolute returns, and in doing so, to outperform the MSCI World and the MSCI ACWI. We invest in 20 to 30 great global companies through a concentrated high active share approach. We're not benchmarked, but outperformance is very much part of the value we seek to add. Year to date, the World Stars Global Equity strategy in dollars is essentially flat, as Jerome just said, down around 20 basis points, while the MSCI World is up approximately 5%. That extends the period of relative underperformance stretching back about 18 months, and we're not satisfied with that. The results at the end of March marked a low for the year so far, and April has provided genuine encouragement. We've seen a strong rebound, and the portfolio has recovered meaningfully from the lows reached during the turbulence of early this year. The long-term 10-year track record of 12.5% net annualized in US dollars remains ahead of the MSCI World's 12.2%. But we know that our shorter-term performance has not been positive in relative terms, and I want to be very direct about what has caused it. So let's look at why stock selection matters. We use two approaches to analyze our performance and identify the sources of outperformance and underperformance. The first is to use an analytical tool to break down performance between all sources coming from sectors, technology, utilities, energy, and so on, and factors such as growth, value, and quality. This is represented by the pink line on this chart. The remainder of the return difference between our portfolio and the market comes from our stock selection. That's the black line. You can see on this slide that most of the difference of our return versus the market has come from our stock selection, and the impact on our active return has been mainly negatively affected by market factors. If we turn to the next page, the second approach is to look at sectors only and allow all other factors to fall into selection. This allows us to evaluate results from a different perspective. So as you can see here, the total shortfall versus the MSCI World over the period is approximately 12 percentage points. Of that, around 2.7 percentage points comes from sector allocation, where we invest and where we choose not to, and approximately 9.3% comes from the selection effect within those sectors. As opposed to the previous chart, this makes it look like our stock selection is poor. However, included in this number are style factors. So let me take each of these in turn. So on allocation, the areas we structurally avoid because they do not fulfill our quality criteria have been among the market's strongest performers. Energy rallied sharply following the change in policy tone under the Trump administration and the subsequent rise in oil prices, which happened as a result of the conflict in the Middle East. We continue to believe that avoiding energy is the right call. Large oil companies are not replacing their reserves, and the long-term disruption from renewables, and ultimately nuclear, whether it's fission or fusion, is a reality we expect to see within our lifetimes. The short-term pain from avoiding it does not change the underlying rationale, and we think the geopolitical reality we're now experiencing will just accelerate electrification and the move away from fossil fuels. We just have to look at how China has been able to invest and how it's getting through this crisis. The same applies to financials. Well-run banks can absolutely benefit from rising rates and deregulation, and we've seen that play out. But financials are not, in our view, the kind of growing and compounding businesses we seek. They're complex, and most jurisdictions are structurally moving towards higher capital requirements to build resilience in the financial system. The Trump administration has loosened some of these constraints, which has contributed to the outperformance of financials, but we do not think that it changes the underlying fundamentals over the medium to long term. So then materials and utilities complete the allocation picture. In materials, we're deliberately absent from capital-intensive mining and resource businesses. In utilities, we believe the large regulated capital bases are in the process of being disrupted. These sectors have performed strongly in the period. We're consistent in avoiding them because they do not meet our quality criteria, and we believe their valuations are now full, meaning the pain of not owning them is largely behind us. On the positive side within our areas, communication services has been a contributor where we carry an overweight. Information technology has been a slight technical drag, not because our positions have performed poorly, NVIDIA and ASML have done well, but because counterintuitively, we're not overweight the sector. We've been disciplined about avoiding the more capital-intensive and cyclical corners of tech, so our large positions in NVIDIA and ASML do not actually constitute an overweight versus the index. The areas that have genuinely cost us on allocation are consumer staples and healthcare, where we're overweight and both sectors underperformed. And within those sectors, the selection effect has compounded the issue. In consumer staples, the drag centers on Nestle and on our spirits positions. In healthcare, it's companies like Abbott and EssilorLuxottica. In industrials, companies like Eaton and Amphenol have faced headwinds after a period of extraordinary performance, and capital-intensive defense businesses, which we avoid, have surged. In materials, our exposure is mostly to Givaudan, a food ingredients business that has nothing in common with the mining and gold companies that dominate the sector weighting in that index. So what I want to emphasize is this. Our analysis of the underperformance shows that the majority of it is factor-driven and cyclical in nature. It reflects a rotation away from quality and capital-light businesses towards the sectors and styles that have benefited from a very specific macro and policy moment. That moment has, in our view, now substantially played out. The valuation gaps have closed. We believe the factors that were headwinds are either plateauing or they're beginning to reverse. So let's turn to the next page, the year-to-date returns. The year-to-date returns chart makes a simple but important point. Things can change very quickly. The best days can come right after the worst. The companies that were among the culprits in last year's negative selection effect, Eaton Amphenol, are already among the top performers year-to-date. ASML, despite all the noise around AI spending and supply chain concerns, has performed strongly. Honeywell, which has been working through its restructuring and separation into 3 entities, is rebounding. This is precisely what we would expect from high-quality businesses once the factor rotation exhausts itself. On the negative side of the ledger, 2 things stand out. First, some of our consumer and healthcare holdings. LVMH, where Bernard Arnault's consciously cautious full-year guidance prompted a sharp market reaction, and the stock is down around 22%, although it has already recovered a lot off its lows. And Abbott, which has faced some business-specific challenges I'm happy to address in the Q&A. Second, our software holdings, Salesforce and SAP, which have been caught up in what I would call this year's equivalent of the DeepSeek panic. The idea that AI, and especially large language models, could simply vibe code their way around the world's largest enterprise software platforms and replace them. We think that fear is as misunderstood and as overblown as the DeepSeek reaction was last year, which caused similar, if not worse, damage to companies like NVIDIA and ASML. These enterprise platforms, Salesforce, SAP, are deeply embedded in the processes of the world's largest businesses. They're not going to be disrupted. They are the companies that will help implement AI at enterprise scale. As we move from early adoption to enterprise-wide deployment, and that transition is genuinely early, large businesses will rely more, not less, on the platforms that manage and structure their data. So the revenue models of these businesses will evolve. Per seat pricing will give way to consumption-based and outcome-based models. And these companies will themselves become dramatically more productive through AI. As we saw when Block announced it would reduce its software development headcount by 50%. We can't promise that share prices will be up 40% the day these productivity gains are announced, but they will certainly provide very significant support for the investment cases. This is the kind of fundamental long-term investing that is the core of what we do. So let's turn to some specific holdings, and I will start with Diageo. Diageo is a business we know very well and held for a long time. It's going through a genuine strategic reset, and I want to be clear-eyed about what went wrong. The company has had 4 CEOs in 4 years. It became overly focused on the premium and super premium end of the market, which left it poorly positioned when consumers, especially in the US, were squeezed by a sharp rise in the cost of living. Price increases that seemed rational in a post-COVID inflationary environment overshot where consumers actually were. At roughly $30 to $35 per bottle for core mass market brands in the US, the proposition had become disconnected from a significant portion of the target market. But the root causes go deeper. The pandemic created a very unusual demand environment. People at home with disposable income and limited places to spend it, which drove consumption and stocking behavior that was inherently unsustainable. When the reopening came, companies faced surging inflation, supply chain bottlenecks, and input cost pressure simultaneously. Margins were squeezed, and the response, understandably but damagingly, was to reduce investment in both innovation and in advertising and promotion. Products began to feel stale. Shelf space and consumer relevance eroded. The new CEO is addressing this directly and decisively. The strategic reset includes rebalancing marketing spend towards mid-market brands, selective and tactical price reductions, particularly in the US, a more ambitious innovation agenda, and a more agile operating model with increased cost savings. This is a company with extraordinary brand assets: Guinness, Don Julio, Johnny Walker, Smirnoff, the list goes on, and a global distribution infrastructure that most competitors can only dream of. On the structural questions, yes, GLP-1 drugs are a real factor, and yes, younger generations are drinking somewhat less. I was at a biotech conference in Cambridge last week, and the pace of scientific progress is genuinely extraordinary. But I do not believe that these trends are existential for Diageo. The pattern is consistent with what we've seen in other areas, like tobacco and chocolate. Volume moderates, premiumization continues, and the strongest brands retain their pricing power and cultural relevance. What we're living through at Diageo is primarily cyclical in nature, compounded by self-inflicted strategic errors that are now being addressed. The valuation already reflects a very negative scenario. At a forward PE of 12.8 times and a free cash flow yield of 6.5% against a 10-year average multiple of around 21 times, Diageo is priced as though the problems are permanent. Our discounted cash flow analysis implies very substantial upside. Year to date, in local currency terms, the stock is now down only around 4%, having already recovered off its lows, which is considerably more resilient than many other consumer names. That's why we believe we are at or very close to the bottom. So let's turn to NVIDIA. NVIDIA is up around 8% year to date in dollar terms and remains our largest holding. Let me use it to make a broader point about where we are in the AI investment cycle, because I think it is genuinely important for understanding the portfolio. We're at the very beginning of the AI infrastructure build-out. NVIDIA is the undisputed leader in the chips that make this possible. Its Blackwell platform, launched last year, set new benchmarks. Its Vera Rubin platform, launched this year, has been described by Jensen Huang's partners as a step change in performance and efficiency, and separately as a major leap forward in AI infrastructure. The indicative order pipeline now stands at approximately $1 trillion, encompassing hyperscalers, corporations, and sovereign AI programs from the United States to Saudi Arabia to France. Demand is extraordinary and extremely well supported. Beyond the hyperscalers, we're seeing the emergence of new players at significant scale. Anthropic is now running at annualized revenues of over $30 billion, growing at a dramatic rate and consuming substantial compute capacity. OpenAI continues to expand aggressively. The sheer number of funded, fast-growing AI businesses competing for NVIDIA's chips is unlike anything we've seen before in this industry. And here's the critical point about how early we are. Only half of SAP's customers are currently on the cloud. That means only half of the world's largest enterprises are even in a position to implement AI properly. Because to implement AI, you need your data to be accessible and structured, and that requires cloud migration. We've just seen a major global business announce it's still in the process of implementing SAP. So we're genuinely in the early phases of this cycle, and the demand for compute to support it has years, not quarters, of one runway. So at approximately 24 times estimated earnings for the January 27 year, falling to around 18 times for January 28, we believe NVIDIA's valuation is attractive given its dominance, its margin profile. Its non-GAAP gross margins are above 71%, and its operating margins are about 63%, and the scale and durability of the structural demand it's serving. We see no credible alternative to NVIDIA's high-performance GPUs over the next 3 to 5 years, and we remain very comfortable with our position. So now let's turn to EssilorLuxottica. It's had a challenging start to 26. It's down around 20% year to date, although it's already begun to recover. I want to explain both why that happened and why we have strong conviction in the long-term thesis. We've held EssilorLuxottica since October 2017, prior to the merger between the two companies. We trimmed the position by 50 basis points in November last year, specifically on valuation grounds. The stock had re-rated to approximately 40 times forward earnings, well above its long-run average of around 23 times. The pullback this year is partly a correction of that extended valuation and partly nervousness around competition in smart glasses, following reports that Apple plans to enter the market in next year. Our assessment of the competitive dynamics is clear. EssilorLuxottica is already 2 full years ahead of any Apple entry. They've sold 9 million pairs of Ray-Ban Meta smart glasses. They fully integrate supply chain from manufacturing through to retail, prescription capability across a vast range of frame options, and a portfolio of brands like Ray-Ban, Oakley, and others that they haven't even rolled out yet, including Supreme, that is genuinely unmatched in the industry. The eyeglasses market is fundamentally different from the watch market, where we have the parallel of Swatch and Apple. Swatch was disrupted because the watch market, at the relevant price points, was really about timekeeping, and Apple simply made a better device for that. The eyewear market is about vision correction, medical need, and personal expression. There are thousands of frame styles, individualized prescriptions, and real clinical requirements. It does not lend itself to standardized consumer product. As our analyst Zixin Xu has observed, and it's a personal reflection of mine as well, wearing my own varifocal lenses, the complexity and variety of what EssilorLuxottica provides is simply not something that Apple will or will want to replicate. And beyond the smart glasses question, the company's strategic repositioning is genuinely exciting. It's entered medical technology, a high growth and high demand area. It's launched Nuance audio glasses last year, addressing hearing health. The unmet global demand for corrective lenses alone is enormous. We think this is the world's leading company in its field. It has been significantly oversold, and the current weakness is a great opportunity. So then, let me make a broader point about quality as an investment factor, and because it's central to understanding why we have confidence in what lies ahead. The MSCI World Quality Index has substantially outperformed the broad MSCI World over long periods. It's not just the last 10 years, it's across the full history of the data. Quality companies compound capital because they have the attributes that allow them to perform across cycles: sustainable competitive advantages, growing earnings, financial strength, and management teams with a genuine track record of value creation. These are not characteristics that only matter in one type of market environment. They're the foundations of long-term wealth creation and of our investment approach. Since inception, the World Stars strategy has outperformed the MSCI World in 76% of all 5-year rolling monthly periods. That percentage was somewhat higher a year ago. The current period of underperformance has naturally brought it down slightly. But it does not change the underlying message. This strategy, grounded in quality, has a strong long-term track record, and the current moment of underperformance is consistent with a pattern that has played out before and reversed. So let's look at it on the next page. The chart on this slide shows 1-year rolling excess returns versus the MSCI World since inception. What you can see is that this is not the first time we've been through a period like this. The last comparable trough was in 22, which in retrospect was an excellent time to invest in the strategy on both an absolute and a relative basis. We're very convinced that the same is true now. The rotation that has driven the underperformance, from growth to value, from capital light to capital intensive businesses, from companies exposed to disruption risk towards those benefiting from deregulation expectations, is coherent and understandable given the macro environment of the past 18 months. But the valuation gaps that made those trades attractive has now substantially closed. The factors that were headwinds for quality businesses are either plateauing or beginning to reverse, as I said. The bad news is that this has happened and it has hurt our relative numbers. The good news is that we believe the bulk of it is now priced in, and as we move towards a more normal environment, we should see a resumption of the outperformance that the strategy has delivered over its long-term history. So let's look at the strategy today. If you look at the portfolio today on some of the metrics that matter: operating margins, return on equity, revenue growth, EPS growth, and leverage, it compares very favorably to both the MSCI World and the MSCI Quality Index. Our companies carry materially lower net debt relative to EBITDA than the broader market. The earnings growth profile is superior. Their competitive positions are, in our assessment, durable and in many cases widening. We've made the deliberate decision not to trade so far this year. That is a considered choice, not inertia. We believe the portfolio is very well and resiliently positioned with meaningful upside across a significant number of holdings. We continue to rigorously assess every position, and we maintain an active approved list and watch list. We'll act whether to reduce, add, or introduce new names when we see the need or a compelling opportunity. But we do not trade for its own sake, and we've not had a reason to trade so far. So, as Charlie Munger put it, micro is what we do, macro is what we put up with. There's considerable macro to put up with now. Geopolitically, we're navigating a genuinely multipolar world. The Trump administration has taken aggressive steps on tariffs and trade. Conflict in the Middle East has driven energy prices higher, contributed to non-core inflation, and weighed on corporate and consumer confidence. 30-year bond yields are at 15 to 20-year highs, and they're a real constraint on asset valuations. We expect it to remain choppy for another quarter or two, but here's what we also know. The underlying US economy remains solid. Employment is strong, household balance sheets are in reasonable shape, and incomes are growing. The structural investment cycle around AI compute and infrastructure is extraordinarily powerful and well-funded, and we own some of the companies that sit at the heart of it. Electrification and energy transition represents the next major wave of investment, with data centers, aerospace, defense, and the need to renew public and private infrastructure as clear demand anchors. These are the growth areas our portfolio is built around. Our consumer holdings are not facing structural demand destruction. They're facing a cyclical squeeze, compounded in some cases by strategic missteps that are now being addressed by new management. The recovery, when it comes, should be powerful, and the valuations at which these businesses are priced today imply a very pessimistic scenario that we do not believe will materialize. As some of you know, I grew up in West Germany with a German father and an American mother. My formative years were spent in a country that was physically divided, with tanks and missiles positioned close to where I lived, in a world of deep and persistent geopolitical tension. And yet, the economies and the markets of that era prospered for investors who maintained their discipline and their perspective. The lesson of history is not that geopolitics does not matter. It's that great businesses with durable competitive advantages, run by excellent management teams, tend to prevail. We're determined to generate performance and outperformance. We're completely consistent in our investment approach, and we're confident that the portfolio is well positioned to deliver it. We will do it by doing what we've always done, investing for the long term, doing our own research, and investing only in quality. So, thank you very much for your time and for your trust, and I look forward to your questions.